Hello everyone and welcome to the PhillipCapital seminar for tonight. The subject for the webinar this evening is on currencies overview and outlook for 2019 and is being presented by David Thang, who I'll introduce to you in a minute. Before I do that, I just want to let you know that if you want to ask questions, you are welcome to do so by typing your question into the dash on the webinar dash there, and David will do his best to answer your questions as he goes along. And we'll also have some time at the end there after the presentation to ask questions as well. So David is a senior client advisor with PhillipCapital Australia and has 18 years experience in the financial markets, having previously worked at firms such as Goldman Sachs and BNP Paribas. David has been quoted in the media on Sky Business and the Australian Financial Review, and is a sought-after commentator for his opinions on the markets. David has a Bachelor of Business in Financial Planning and specialises in analytical and technical analysis. So without any further ado, I'll hand over to David, who will present tonight's webinar. Thank you.
Thanks, Nigel. Hope everyone is well. So just a quick sound test for everyone that's in the room. If you can just type away in that chat, just to let me know that you can hear me okay, and you can see the initial slide there with PhillipCapital. Okay, I'll just give a few moments there. Okay. Great. Alrighty, so I'm just going to kick it straight off. So thank you attending for everyone. And those in Australia, it is about just past 7 p.m. So I do appreciate you taking the time away from dinner. And for those of you offshore, thank you for attending. So let's jump straight into it. So first up, in terms of any content that I'll be presenting tonight, it will be general in nature. So basically what that means is that I've prepared the presentation without taking into account your objectives, financial situation, or needs. So always take that into account. Alrighty, so I'll give you some time just to quickly read through that, and let's jump straight in. So in terms of today's session, I generally like to run things rather informal. So if you do have any questions or I'm running a little too quickly, feel free, use that chat button there and just type away and let me know. And as Nigel mentioned, I will do my best to answer any questions as I go. So I'll run for about 30 minutes to about, let's say between 30 to 40 minutes, and hopefully I won't bore you too much. So the main point of today's session is I want it to be as practical as possible. So I'll be providing you with my thoughts in terms of the macro environment. We're going to run through a few slides, but ultimately we're going to jump straight onto the charts and we're going to do some real-time analysis. So the key takeaway is to be able to, for everyone that's in the room, essentially be able to finish today's webinar and I guess gain some insights in terms of how I look at things and how you could potentially also use that as part of your arsenal in terms of your analysis and your trading, of course. So we're going to have a quick discussion on the macro side of things, any event risks that's obviously hovering around the markets as we speak, look at the key economies, and of course the key part is how we're going to interpret it, analyze it, and then use it to actually trade, because ultimately that's our goal. Alrighty, so in terms of, I guess, event risks, nothing new. It's the same key points that's been plastered across the media, and it's nothing new. So the first one is, of course, Trump versus the rest of the world. Whenever Trump tweets, as my clients know, basically he's just going to send the markets down. Now, mainly it's the equities market, and the way we see it is he'll tweet, he'll push the market south, and they'll present us with opportunities to be buying quality companies at a discount to market. So looking at it from an equity perspective, but of course we'll jump into it more from a currency perspective as well. Now, Brexit has been looming for a long time, and it doesn't seem like it's going to get any better. So that's always in the background, and of course any negative news headlines out there will likely impact the sterling, the GBP, and we'll likely see that head south. Nothing new once again, yield curve inversion, and it's no, people say it's a recession indicator. Yes, maybe once or twice, but in terms of percentage accuracy, that it hasn't really been all that high, to be honest. And this is probably the main one. So contraction in the global economy. It's been talk for the last 12 months, and look, chances are things are starting to slow down as per the economic indicators that we're seeing, and which I'll run through shortly. So the key economies. Now, people they're talking about this recession. When is it going to come? Ultimately, if you keep focusing on trying to pick the year that is going to come, that's going to deter you from your actual trading. So it's one that's in the background once again. And ultimately, you can listen to the central banks across the globe, and generally they're going to say we're late to mid-cycle. Okay, so just bear in mind that they have been saying that we're in this late to mid-cycle for the last 18 months, and the markets continue to rally, so I wouldn't put too much faith in that. Now, the thing is, the bond market doesn't cause recessions. Like, it may 10 to 20% of the times, but ultimately it's dependent on banks. And if banks start to tighten, which they have in the past, then that puts a squeeze on the overall market. But if you think about it, US banks are open for business, so they are lending, okay, and monetary policy is definitely loosening. Likewise, Chinese banks were tightening. Now they're beginning to unclip the belts, as per se. And domestically here in Australia, we are seeing lending requirements ease. More people are finding it slightly easier to get home loans nowadays in terms of lending. But overall, I guess in terms of the Australian economy, if lending requirements are loosened or more flexible, then people will start getting more loans, and ultimately that's a good thing for the overall economy. Now, I'm not going to run into too much detail in terms of the economies because that's more longer term, and I'll explain why down the track. But the key focal point is GDP. Right, so if we look at a company, we're looking at earnings, we're looking at revenue. But from a global standpoint, we're generally focused on GDP when we're looking at economies. So we can see that it's tracking around 2.3, but overall in the US, things are slowing down. So I'd say that the economy is okay. It's not fantastic. But overall, if you compare it against the global economies, the US is certainly standing its ground. And these are just a number of forecast numbers, so Q3, Q4, and so forth. And next year, we are looking for that slowdown below 2% growth annualized. Now, just taking a larger snapshot here and looking at the bigger picture view. So the inflation in the US is okay. It's around that 1.7% mark annualized, looking to increase slowly as the quarters tick on. Interest rates, I'll touch on that a bit later, but the Feds did cut rates overnight. Well, for us, it's overnight by 25 basis points, down to that range between 1.75 to 2. And of course, the other one that I'll look at is PMI. So as long as PMI data is tracking above that 50, that is always a good thing. So I'll leave that here for a quick one, and we're going to focus locally in Australia. So all in all, the cash rate is at 1%, but chances are we may, in terms of futures pricing, we may see another 25 basis point cut here. So it's been a very, very long time since the cash rate's been below 1%. So we shall see how that goes. Inflation, similar to the US, we're sort of slowly edging closer towards their mark, around 1.6%. Unemployment, new number was released today, so that's ticked up a little. So it's about 5.3%. August numbers in terms of employment did come in better than expected, but ultimately the market has honed in on that unemployment rate ticking just a tad higher to 5.3%. And in terms of our composition, what really makes up our economy, and when I say our, I'm talking about Australia. So as you know, 60% of our exports is in that resource sector, and thus we're a commodity currency. But the main thing is household debt is quite high. So nothing new, but it is one that you do hear a lot of in terms of a bit of a, I guess, a thing to be cautious of. Now, in terms of economic drivers, so generally in the past it's been interest rates, direction of interest rates, but nowadays everything's all priced in. So, in terms of the cut overnight, everyone was expecting it, the market was expecting it. So really, when the market has already priced something in, an event risk in, then it's nothing new, and that's why we saw the US dollar actually head upwards. Traditionally, we'd expect it to come off quite substantially, but we are in a very unique environment where global economies are essentially in consensus mode, where they are quite dovish, and they are looking to push rates slightly lower. So that's likely to remain for the remainder of 2019. There's about 3 months to go, and 2020 I'd say, is when the action is going to really come through. And with that being said, central banks will focus on these both leading and lagging economic indicators. So they'll be closely watched, and central bank in the US, Mr. Powell, he did say that they will be essentially monitoring that fairly closely. And if we sort of think about it in terms of the US, so in terms of last night's cut, there was 15 members, 5 voted yes to cut, another 5 voted yes to cut, but no more cuts for the remainder of this year, and 5 members said no. So it's quite a divergent split, all in all. So it is quite hard to see, or rather difficult to see, another 25 basis point cut this year. But if you look at futures pricing, it is about a 65% probability. So just bear that in mind. Okay, and just going back on this page one more time, in terms of any economic indicators, as most of us in the room will probably already know, it's all about expectations, and it's all about beat or miss, and that's going to be the impact on the currencies over the short term. So now, regardless of your view being the economy strengthening over the next 12 to 24 months, that's not something that's easily tradable. So you really got to look at the more shorter term economic announcements. Okay, so in terms of the analysis side of things, and this is where I'll try to get a little more practical rather than running through PowerPoints, because it can be a little dry at times, and I do find that dry myself when I do attend webinars or presentations. So that's why I've tried to keep it rather short. So in terms of looking at I guess, regardless of any market, so I'm always looking at the thematic view. So longer term view, that's going to give me the direction. Okay, whether it be the S&P 500 or currencies or equities, your thematic is going to give you that direction. And the short term, the strategic view, is where we're going to be trading through, or we're going to be looking through opportunities. So I'm going to run through how I use technical analysis. And look, most traders, I'd say 98, 99% will be using technical analysis. So it's not anything that's brand new, but I just want to show everyone my take, how I sort of use things, and how you might be able to add it to your set of tools. Alrighty, so quick summation. Now everyone's probably going to know about support and resistance. Now it's simple, it's easy, but it's so powerful. Now the traders at Goldman's, BNP Paribas, AMP Capital, they all look at support and resistance. Okay, so it's very, very important, and don't rule it out. Definitely do not rule it out. Now, another thing that I'll look at is structural support. So if can everyone see the arrow there? So I'll just quickly change it to a laser pointer. So just focus on this, on the red here. If anyone has any issues seeing that, let me know. Just type away in that general chat. But what I'm looking for in terms of, let's say, getting into a long position. So there's breakout traders where they're waiting for prices to break above a previous high. And let's say this horizontal light blue line, let's say that's $20. It breaks above $20, they look to get set, they look to trade on the long side here. Now, you can look at trading breakouts, but I've personally found over the years that it tends to fail more often than not. So you'll get triggered on the upside and then prices swing back, and chances are you're probably going to get stopped out. So a more conservative approach is to let the prices break. They'll break, let it run, don't chase it. On the retracement or on the pullback, I'm waiting for a retest of that $10. Let's say that horizontal mark is $20. I'm waiting for a retest of that $20 mark, and note that it'll probably go through 20. It may get down to 19.50 or flirt around with that level. Once it stabilizes, then I'll be waiting for certain price action signals to be getting long here. So it's conservative because you have not taken this initial break and you've let it run, you've waited for that retest, and then you're looking to enter on the long sides or looking to buy. Now, any questions, feel free, jump in, let me know. Otherwise, I'll just keep going. So on the short side, we're using a very similar methodology. So prices are following this red little dot, comes down, let's say that's $20 once again, breaks through 20, let it drop, could drop to 18 as an example, wait for it to retest that $20 mark, may pop to 21, doesn't matter, wait for it, price action signal. On the failure, then you look to get short. Okay, so this way, if you set your stop loss just above here, then you've got that protection of that retest. And if it does swing back, which it could, probability wise, it generally does head south. So you're well protected there. Rather than trying to take that short here, and if you get that false break to the upside, you'll be sniped out of that pretty quickly. Candlesticks, and anyone using candlesticks or bar charts or line charts, just let me know in that general chat. But otherwise, my preference is candlesticks. So I used to use bar charts early on, but I've actually found candlesticks to be pretty reliable. They're easy to analyze, and essentially the anatomy is the bullish candles. Here's the body. There's your high wick, your low wick, opening price, closing price, and vice versa. So I'm not going to run into this in too much detail, with the assumption that we do have some knowledge in terms of candlesticks and charts. So there are about 48 different types of candlestick patterns. Okay, so you can try Google candlestick patterns online, but I like to focus on the strongest and the most reliable candlestick formations, and it's really simple. Hammer down here, I love them after a strong pullback in share price, or currency. Now, when that occurs and you see a bullish hammer, it generally indicates that the market is ready to capitulate and swing back to the upside. So in this case is the upside. How would you take the entry? Let's say, for example, if we're looking at currencies, on this candle's high, which is up here, I generally, if I'm trading off a daily chart, so I'll run into this in a bit more detail, but if we're trading a daily chart, then you want to wait for that 5 pip break above. 5 pips above and you're in. On the short side, I'm looking for a shooting star. Okay, so pretty much a reversal of that hammer, but these two candles alone, if you spend some time and just look over the charts or the markets that you trade and look for these candles and just analyze, just have a look at how prices move afterwards. The reliability of the direction afterwards is actually quite strong. Alrighty, so in terms of forecasting, I use Fibonacci. Right, so a lot of people use Fibonacci. You may use Elliott waves, but I find Fibonacci very reliable. So for those of you that aren't familiar with Fibonacci, you're measuring the low to high of a move, impulsive move, and on the pullback, either one of these retracement levels will likely act as support, and we are forecasting the move down. Okay, so another thing you'll notice when I switch to my charts is that I actually don't use indicators. So I'll run through that shortly. But in terms of extensions, when prices are starting to move up, there are 2 additional upside targets there. Okay, using the 1272 extension and the 1618. So let's have a look. Okay, so what I'm going to do now, everyone, is I'm going to switch to the charts away from PowerPoint. So here we go. I'm going to switch this over. So just bear with me for 1 second. Main screen. Okay, let's go to main screen. I'm just going to try and switch this over. So it's always fun when you're in practice mode, it works perfectly. And when you're live, it's not doing what it wants to. So just give me 1 second. So I'm going to try and switch this over. Let's go to main screen. Okay, let's try that. Can everyone see the chart behind us? Okay, so here's a chart of the S&P 500, and so I already have some analysis here on the S&P 500 index. So what I might do is I'll actually remove the analysis, and I'm just going to quickly talk about, or quickly analyze the S&P 500, and then we'll take a look at Aussie US dollar. And after that, we can take some questions in terms of which charts you want to take a look at. But generally, if I'm looking at, let's say, the S&P 500, you have to focus on the time frames. So the longer the time frame, in this case, we're looking at monthly charts, that's going to provide you with stronger levels. So these charts here will give us the longer term direction. And then as soon as we start dropping down to weekly and daily, the daily is more going to be our trading time frame. And for those of you that are intraday traders, you may be dropping down to 4-hour, hourly, or 15-minute charts. Now on the S&P 500, so we're obviously we're right at the top end of the cycle, right at resistance here. And overall, it's been pretty, well, I guess the market's just been gyrating upwards. So nothing, equities, you just really had to play the long side here. And there's a lot of bears out there, but you'll be doing it pretty tough if you're consistently trying to call a market crash. So it's ultimately very important just to keep the focus on where the dominant trend is. And I'll just put in a quick retracement. Talked about low to high. Now on the chart, so you're looking for key turning points. So key turning point on the downside, key turning point on the upside. Now I can go ahead and draw a retracement off this low to high, which I'll show you just to demonstrate one point, low to high. And remember those retracement levels. So if I put in, this is what we call a 382, 38.2%. I'll just remove this one here. So as you can see, the 38.2%, which is that first support level that we're looking for, that's miles away. All right, so this is a really longer term view. So what's most relevant, this is where prices are. You're looking for the most recent decline in share price, okay, which is around here. So down here is when things are most relevant. So we would go low to high, draw in our retracements. I'll remove this orange line, which is the extension down there. We don't need that just as yet. And on the monthly, what can we say? All right. Long-term uptrend, things are still pretty strong. Yes, we're running towards top end of resistance around 3025. Directional view, thematical view is still favored to the long side. We drop down one time frame to the weekly. Things are a little easier to focus as per se. So we go low, we go high, and notice on that pullback, and what type of candle is that? All right, so no, that's very close to a hammer, right? Because we have a very long wick down here and a small body. And when prices, you notice that when prices break above that high here, so if I just draw in a quick horizontal line off this high, when it decisively breaks through, that's when we get a sustained move to the upside. And you will notice that until we got a sustained move above, we spent 1, 2, 3 weeks in consolidation mode. And it's only when we got that pop above, that's when we got this move straight to pretty much the previous all-time high here. Now you're probably thinking, okay, so the directional view is upwards, but how can we sort of trade this? Okay, so if we break above previous highs, we need to have some potential upside targets. So to do that, once again, we use our Fibonacci tool. We take that high, and this time we're going down, right? So we're following the move down. We draw in our retracements, and you will notice on my slide with our retracement levels, I'll just put them all in, and extension levels. We talked about extension levels providing us with upside targets. Now, the way to use these upside targets is they don't get activated automatically. The only time they get activated, which is these orange horizontal lines, is if you get a break above this level here, which is the 78.6% retracement, or what I call the 786. You get a sustained break above and a close above, so a weekly close above. Now, if you're looking at a daily time frame, you need to wait for a daily close above. You get that close above, then boom, we have our upside target there. So once we have that upside target, I like to keep my charts fairly clean, so I just remove everything else. They're all being breached. They've done their task. So now what we're looking for is gyration, a retest previous high, and potentially a move to 3094. Okay. We drop down to a daily just to see how things are moving. Are there any trading opportunities here? And I'll just squeeze this chart a little higher. And let's just squeeze this a bit more. So on the daily, as we can see, when prices move up and they start forming these shooting stars, then you generally get that pullback in price, and we get volatility in this consolidation because of everyone's basically waiting for that Fed announcement last night. So based on that, that's done and dusted. Strong balance sheet, which Mr. Powell has mentioned, and that's managed to save grace in terms of last night's price action. So over the short term, if we get a break above this previous high here, okay, then we'll likely see a move boom up here and a breakthrough. This will be the medium term target, 3094. Now I also talked about structural resistance and also looking at structural support. So you could play the conservative card, and that is you'd wait for a move, you wait for that break above 3025, you let it run, and you wait for a pullback, you wait for that retest. If a hammer forms, one of these, or a bullish doji which looks similar to a hammer, you could use that as an additional entry point for a move up here. So overall, things look pretty rosy on the S&P 500. So once again, levels to watch are 3025 and 3094. Okay, so I'm gonna have a quick look at Aussie US because I've noticed that we are running into time pretty quickly. So I'll just quickly bring up AUD USD. So this is Aussie US, and I do apologize. So it's quite difficult to show, I guess, all the analysis in a half an hour window, but I'll do the best I can. So normally with currencies, I don't really look at the monthly chart because that is quite longer term, but we can look at the weekly for your thematic direction. And I personally trade off the daily. Okay, so it is more longer term, so I am holding onto positions for 1 to 6 days. Now, obviously, if you're trading an hourly chart, then you'll probably be in trades between 1 to 5 hours, roughly. But in terms of my view, the Aussie doesn't look all that great against the US dollar, and we've seen this move up here. So I've done a retracement of this high down to low, and as you can see, the 50% retracement has offered topside resistance, and it started to fail here. And now obviously this is this week. So if we take a look at the daily in terms of the trading time frame, so this is the more tactical time frame that we're looking at right here. So on that major recovery, we hit the 50%, and if you look at that candle right there, I'll just move the cursor away, you'll notice that that's pretty much a shooting star. So although this candle body is not red, it's green, but I focus on the shape of the candle. So you always want to see a small body and a long wick, which is that part. So if I just move that arrow away, and if you see a long wick, that's exhaustion. All right, so the candle itself will tell you that, will give you insight in terms of the likely direction over the coming days if we're looking at a daily chart. And it so coincides with the 50% retracement, okay, using Fibonacci. So where to, right? So from here, there was a short position or a short entry. You see the shooting star, and you're basically waiting for 5 pips below that low. And that low is 68.59 for those of you that are interested. So 5 pips below that, you take your short position. Stop loss, you could place at 5 pips above that high. And if you're looking for 1 times reward, you're looking for a move down to about here, and you would have hit your 1 times reward target. If you're going for 2 times reward, you could be looking down here. But ultimately, in terms of direction now over the short term, things are looking rather negative. But our task is to look for potential support levels or where prices will likely stabilize. And to do that, major key low swing, we go take that to the high. And then once we bring in our retracement levels here, 382 has been breached. I'll bring them all into play. And I'll just move this out of the way. So obviously these are full of ads. So they'll pop up every 3 minutes or so. But on the 382, that's a breach. It's got down to a 50. It's starting to hold around 67.86. Anything that's been breached, let's remove that 382. So in terms of our Fibonacci levels, the way I view it is you wait for the reaction. There are traders that set long entries just above the retracement levels to get long, but that's quite a risky way of entering your trades, because just because there's a Fibonacci level there doesn't mean that the price is going to stall there and reverse and shoot back up. So I always wait for the reaction. So on the 50, it's holding, but I need to see a hammer. So our bullish hammer, thinking back to the PowerPoints, a bullish hammer as of the close, so on the daily chart, we're looking for a New York close, and that's very, very important. So PhillipCapital's MT4 platform offers New York close. So you want to see the New York close because that is the proper close when it comes to Forex. And that will give you the proper daily candles, which is what you're after if you're looking for a daily chart, and that's the most reliable. So if we get a bullish, if this candle somehow closes up here and forms one of these types of candles, then I'll be more interested, because it's shown that that reaction at the 50% retracement has held and it's stormed back up, could be ready to be shooting back up, and you'd be looking for that 5 pip break above the high. Now, doesn't matter, from our perspective, it doesn't matter if that Aussie versus US turns here at the 50 or the 618 or the 786. These are our forecasted potential turning points in the days ahead. So if it doesn't turn here, it breaks through, it breaches, I'm looking at the 6.8 as the next support level at 67.60. If it takes this out, we're looking for the 786. So it's really a waiting game. Okay, a waiting game in terms of when it will hold, it will turn, and it will offer us one of these types of candles. And I only take trades when I see these types of candles and no other candles. So that's the way I've filtered things out over the last 10 years trading currencies. And it's really a matter of just being patient. And you don't need to be staring at your charts all day long, to be honest. You're literally just waiting for that close. And in Australia, New York closes from memory about 8 a.m. And that's essentially what you're doing. Waiting for how prices react, and you're waiting for your hammers to be looking for potential long entries. And vice versa, short entries right here. That's your potential short entry, which is your shooting star candle, or some people would call it a bearish doji. Okay, so essentially my view on Aussie US, thematic view is that there's going to be lower levels against the US dollar. From a shorter term tactical view, I'm looking for further downside over the short term, but I'm looking for prices to find some ground at either one of these retracement levels for a potential long entry. So despite what's happening in the background, in the macro side of things and economic indicators and so forth, if you could spend weeks on end trying to understand that and predict that, but economists always get that wrong. So just bear that in mind. And even if you have a strong view on a certain economy, it doesn't really impact the way you're trading. So I could be bullish on the US economy, but I would still take short trades against the US if there are trading opportunities, because my time window is very short, like in terms of 1 to 6 days for it to work out. So So we've sort of run towards the 45-minute mark. Any questions from anyone at this stage? I'll just have a look. All good.
David, just on that trend indicator that you had on your slides before, when it moves through a bit of resistance, moves up, then retraces back to that resistance, uses it as support, and then bounces again.
Oh
Are
yeah.
you looking at volume on that as well? Do you need to see an increase in volume at all, or you're not so concerned about volume?
Good question there, Nigel. So if I'm looking at stocks, then I would definitely look at volume. But if I'm analyzing currencies, I don't put too much weight on volume from that perspective. So when I'm focused on currencies, it's mainly the price action and how it reacts to Fibonacci levels. So we don't really have time for that today, but in terms of expanding the scope of Fibonacci, I actually draw multiple levels and I look for overlap. So we're looking for confluence. So if there's more overlap at a certain price range, then that essentially indicates that there's potentially a support to come through there. Any questions from anyone else? Okay, so what I might do with the time constraints, so I've basically given everyone just a bit of a taste of the way I sort of analyze markets, and now you can use this type of analysis across any market, and that's why I love technical analysis. Technical analysis. So now we've seen on the S&P 500, you can do it on the XJO for the Australian index, any currency pair, crude oil, gold, and of course stocks, and regardless of that being in Australia, US, UK, or Asia. So once again, it's very powerful. So it's a great tool to use. And if you look at stocks, I guess a lot of fund managers look at fundamentals. So I'll look at fundamentals as well, but the first, I guess, filtration criteria is always charts. Because a company could have a fantastic 12-month outlook, but if the chart is heading south and momentum is favored lower, psychology-wise and sentiment is really just telling you to hold off. So it's quite key to be looking at charts. Alrighty, so on that, seeing that there's no other questions coming through, I'm sort of just going to wrap up shortly, and I'm just going to swing it back into my PowerPoint screen, which I'm trying to do right now, and it's always fun. Here we go. So to wrap up, so just a few little pointers that I've sort of learned the hard way over the last 18 years. Learn to take losses, everyone, especially those of you that are trading. And regardless of how long you've been trading, no one likes to take a loss. It does hurt, but we're going to take losses. So it's part and parcel of what we do, and you have to really think in terms of probability. So now you could have a strategy that yields, let's say, a 60% win rate. So out of 100 trades, your next 100 trades, you're going to get 40 wrong. Okay, and the crucial thing is you're never going to know when the 40 is going to come. So you have to expect losing trades, and you have to have thoroughly back-tested your strategy. Okay, because you could start, let's say you put on your next 10 trades and they could all be losers, right? And you're probably looking for the next strategy, but you got to have faith in your strategy and always think in probability. And never revenge mode trade. So you take a losing trade today, and tomorrow, well, not even tomorrow, straight after that losing trade, you're looking to double up to make it back. I'd say never ever do that, because you're going to blow your account pretty quickly, and you're going to blow many accounts if you do that. So risk management, crucial. People use 1%, 2%. stop losses like 1% of your trading account as a loss. I prefer to use dollar amounts. So say for example, you're going to risk $1,000 on each and every trade. You could risk $500 per trade or $100 per trade, but keep it consistent, because ultimately the only thing you control is what you're going to lose from the outset of the trade. Now you've probably heard this 1,000 times. Trend is your friend. Trading with the trend is probably easiest, but obviously there are counter trend opportunities. So in that Aussie versus US dollar example, that short trade was against the impulsive move, which is going up. So I trade both sides, longer term and with the trend and counter trend. And ultimately, there's always tomorrow. Okay, so I know I'm sort of focusing on taking losing trades and being comfortable with it, but that's the hardest part. Okay, you really got to control when things don't go well and just take a break. There is always tomorrow. So in terms of myself, I generally work with clients here in Australia, high net worth on equities side of things. So any questions or you want to get in touch, there's my contact details. And on that note, I'll hand it over back to Nigel.
Thanks, David. That was very informative, and I'm sure we've all learned something out of that presentation tonight, especially on the charting side. That was very insightful. So I just want to remind everyone in the room that this is being presented by PhillipCapital, and we do offer MT4, the MT4 platform for currencies and also CFD trading in indices, commodities, and precious metals. So we do have spreads from 0.3 pips. We offer zero commission. We're fully regulated by ASIC, and we offer a straight-through processing offering as well. So we don't take the other side of your trades. We don't B-book. We don't run a dealing desk here at PhillipCapital. So we want you to succeed in your trading, so you continue to trade with us. We're also backed by the PhillipCapital global brand. So we have $35 billion in assets under management and custody, million plus clients globally, and we operate in 15 countries worldwide also. So what we'll do is send out just a follow-up email with our contact details and just a bit more information on our MT4 offering for you. So yeah, look, we appreciate you attending tonight, and we will try and have something going forward. We'll send an email out and let you know when our next webinar is, and we do appreciate your attendance. Thank you very much.